We are one of the few countries which still insist on an exposure before somebody can enter a foreign exchange market, but still want our currency futures market to be completely opened up. To me, this is still contradictory, but we have done that. And what we have done recently is try to ensure that there is a level playing field for both the markets. Now, that's why the question is, how does such a market, where there is free entry and exit, how can it coexist with the OTC market subject to the controls? So the second related issue that I ask, following the G20, is that is it time that when we talk about plain vanilla forward contracts, do we move them all to the futures market? Controversial, think through that. Now we have tried to bring parity, as I said, but having an underlying requirement in the futures market is something unusual, so we'll have to get over that. We also will have to be conscious about the fact that as we speak, although nobody has exact numbers, everybody thinks that NDF market is burgeoning. I would challenge anybody here who comes and tells me this is the exact number, what is happening in the NDF market. Nobody has a clue, but everybody has a number. So but given the fact that even impressionistically we think that that market is burgeoning, if it is burgeoning because of we sticking on to certain archaic rules and regulations, it's time that we remove it and make sure that those agents who want to actually cover their exposure on account of their interest in India is brought on shore. Now, what I have tried to briefly explain is the enormity of the Reserve Bank of India's task. Full control or no control are good regimes for a regulator, but the present regime is like a half marriage. You are neither fully married or you are a bachelor. Now, this is where most of the challenges are faced by the regulator. And this is the scenario that the agents will have to take as given when they manage risk. Now, I had flagged several issues when I spoke 2 years ago, somewhere around Perel in one of the hotels, and my copy of my speech is still available on the website, which is said, managing currency risk in a new normal. The question is, some of the fundamental issues which I raised there are valid even today, but have the questions been learned? Are corporates better prepared to manage volatility today, and have they moved away from what I call there is no tomorrow syndrome? Today, the intrusive regulations, prescriptions in the name of financial stability is being increasingly resorted to by regulators around the world. Now, this kind of intrusive regulations, particularly in the foreign exchange market, has gathered pace after there were evidence of manipulating the foreign exchange rates in some of the major markets. So in many countries, this is an issue where the regulators are becoming increasingly intrusive. Now, they are also concerned about the kind of activities of various economic agents, in turn having impact on the real sector, which is directly relating to the unhedged position or the speculative positions taken by the players. So how do we move forward in such a scenario? Now, the related question that I have there is it time today that we redefine what is an exposure? We always think that an exposure is something I look on either side. I have an exposure on the liability side, I have an exposure on the asset side. But is it time that we think that the real exposure is net of this in quantity terms? However, there could be mismatches in flows which will have to be taken care of through swaps. Again, a controversial question, but think through this. So do we allow these corporates, particularly the large corporates who are perhaps having books which are bigger than most of the banks in this country, who are working with highly regulated regime of open exchange positions, interest rate mismatches, etc. No such things are given to the corporates. So is it time that we start looking at these large players? How do they manage their exposures? Not get too intrusive, but to say that what is the kind of activity that can happen? Number one. The next issue that I want to flag is that Today, somehow or other, we have moved to one extreme and said that a plain vanilla, beyond plain vanilla, nothing is available to the corporates which is linked to the size of the balance sheet. Probably some of you may come around and argue that the size of the balance sheet has nothing to do with the risk management capacity and the ability of a particular corporate. So do we rather look at that and say that subject to this you can have, because if I have, it must be understood that it is always expensive to do an insurance at the age of 55, a life insurance, rather than at the age of 20. So having missed this at 20, rather than saying that at 55 this is not available to you, do you think that it's time that you make this available subject to certain safeguards? Otherwise, the concern of unhedged position will continue to remain, because always the hedging is a cost, is a balance between the cost and what I expect to happen in the market. Now, one of the issues that Venkatesh has been talking to me, I don't know whether he still talks about this, but he has at least raised this issue with me a couple of times, which has become relevant, particularly after the issue of forex rates manipulation happening in various markets, is that is there adequate transparency as to how a foreign exchange rate is quoted to the customer? Do we need to make this more transparent? And when we talk about transparency and consumer protection across the banking scenario, are we missing the foreign exchange market part of it? Now, again, earlier we had said that there could be no broking as far as a customer transaction. The worry was that the broker may hold on to a position. That was true in a manual scenario. Now that everything is electronic, do we still stick to this position, or do we move away so that there is more intermediation and the kind of monopoly that some of the players have? And one of the problems that have been repeatedly flagged to us is that the small people are not getting best of the rates, or they are being taken for a ride. Can that be addressed? Now, the other thing is about the long-term hedging facilities in this country. When I started, we did not have a foreign exchange market beyond, let us say, 1 month, 2 months, 3 months. As I'm about to retire, we have a market which is liquid at least up to 1 year. But what happens after that? Why there cannot be markets for long-term hedging, which becomes increasingly important when today India is being looked at as an attractive destination, particularly after the new government took over, where people are looking at pumping money for the infrastructure projects. But they need some kind of a long-term hedging. Is the only way possible that such kind of market will have to be provided by the central bank, one way or the other, to start off. And how do we wean away the lure for gold, or how do we give them adequate returns by having gold-linked, return-linked products, which in a way is important for the foreign exchange market also, because if we are able to recycle the gold available within the country, then the pressure on the imports will go down. I stop here, leave you with some of these thoughts. I'll be happy to take questions and probably enter into a debate. You can ask any questions, you can provoke, but you must be prepared for an equally provoking answer. Thank you very much.
As you very well placed about the consumer protection in terms of export margins, etc., we have seen a couple of times, very frequently, all banks charge different margin, different to the different customer, or probably many times to the same customer. Some work on 1 paisa margin, some work dictate 4 paisa margin. When the situations are highly volatile, they take a big piece of cake, and you can't do anything about that. So how do we take this forward, or how do we talk to the banks, like there should be a very decent or a reasonably placed win-win situation margin. What do you guide about this?
See, what I guide about this is that some of the initiatives that were started is that whether there could be some kind of an institutional mechanism which actually provides this intermediation and the rates which are transparent, right? But having said that, let me also make it very clear that there is a clear difference between a fixed exchange rate and a managed float. The margins will have to be reasonable, but it cannot be same across the board. So that I think that regime we should accept that cannot be achieved, because that will become very difficult or too prescriptive. But however, I take your point, and this is a problem not related to India alone. Please remember that the margins for the so-called SME customers or MSME customers, irrespective of whatever product they are dealing with the bank, and the costing of that is an issue across the world. But what we are trying to achieve, where I am completely supporting, so I don't have a ready answer, but probably the only way or the first step of achieving that, according to me, is through increased transparency.
So can RBI ask bank or give a range, like it's anything between 1 paisa or 4 paisa?
Yeah, but
so
how
does
central bank decide what should be the 1 paise or 4 paise? Normally, how it happens across, or how it should be likely to happen, is through a good self-regulatory organization which develops and tries to drive the market into a proper market behavior and discipline. The central bank saying that it should be between 1 paise and 4 paise, probably at this stage of development of the market, personally I would think that will be a retrograde step.
So in that case, at least the SMEs or the small scale or those who have less approach can at least be better off than at the vulnerability of the banker.
Anyway, the point well taken. The issue is engaging our attention. Probably we don't have a solution which is acceptable and which is controversial. We will keep talking about it. People who have ideas, please get across to us, and we will see what could be the best possible solution. But yes, because there is another related issue involving foreign exchange, but not directly the kind of risk that we are talking about, which again I am getting increasingly concerned about, is the kind of exchange rate that is getting charged for use of your credit card overseas. This is getting to ridiculous levels. And some of the countries have started intervening in that. I am saying, let us have, again, we are stopping short of direct intervention, but again, we go back to the point. One of the things that we are trying to explore there is looking at the international scenario, where there could be an upper cap that we prescribe and say it cannot be more than that. Because, I mean, you could take bad examples. One of the bad examples, I don't know how many of you know, is Australia taxi drivers. Australia taxi drivers, they are allowed to accept only a domestic card which is issued and accepted in Australia. If you use your if you give any kind of cash, he will say he doesn't have the change. So you will have to use a card. If you use any card other than the Australian issued card, your surcharge is 10%. 10%. So these are the practices around. So this is where the small value transaction is an issue. But I agree with you that we need to find a solution, but think through. If you think that there is a better way, I personally think that it has to be through a sort of a self-regulatory.
Sir, one more question regarding what are the criterias in front of central bank or RBI to decide the level of exchange rate suitable to the country in given circumstances?
There is no definite answer to that, because there are no numbers which remains even the same during the course of the day. It depends.
Then how do we intervene? Why do we intervene?
I'll come back. What we say is that we intervene to make sure that there is not too much of movements in the currency.
This is one facet of the side, but there has to be some base, like which RBI feels like these are the ranges, or or the government, or which is suitable in
See,
terms of export, import, or BOP?
Suppose I tell you as an hypothetical answer that Reserve Bank's range is between 55 and 65. That is not going to give you any kind of comfort.
True.
Right? But on a daily basis,
It's
how
just an academic,
it gets
satisfaction.
done is that on a daily basis, there is a financial markets committee which meets in the morning at 11 o'clock. They have a fair bit of idea by talking to the market participants, like what are the kind of large inflows and outflows they expect, and what's the kind of gyrations that it could bring about in the market. Then they take a call that what they need to do. But again and again I am saying that prima facie we have moved away from targeting a particular rate. What we make sure is that due to the actions of some of the economic agents, others who are not even a part of that game, this is where the risk management becomes important. Why people rushing, or the leads and lag situation creating volatility in the market is a problem for the market players who have to do this transaction on a spot basis, and he is no way a part of the game. So he gets affected because of the actions or inactions of the other players in the market. So this is where the central bank needs to take a call. How do we manage the movements in the currency in an orderly manner? Beyond that, this is something right from the governor we have been talking. People perhaps talk at different levels because they don't think it is true. Reserve Bank has a rate, we don't have a rate.
Thank you, sir. One more last question, sir. Looking into the introduction given by Venkatesh ji, and sir, you spoke about the SMEs, MSMEs. One recent change, a big change which has come from the ECGC, just because of default or for any reason, some exporters have defaulted or manipulated or whatever. ECGC has asked or raised the coverage charges or the premiums, which comes to more than 5 or 7 times what we were paying before. So is it not a time like RBI or a good forum like or any central bank or could ask government to look into? Otherwise, the whole purpose of ECGC or the country's exports or the small sectors across the country is highly it's detrimental.
I must admit that I do not know much about what ECGC does or what is the rationale of what they are doing, but my academic answer would be this is what we are trying to do in our own organization with relation to our Deposit Insurance and Credit Guarantee Corporation, is that increasingly for this to act in a very rational manner, we should move towards a risk-based premium. So if there are instances of these exporters